Everybody wants to know how to build a bulletproof dividend stock portfolio with their first $1,000. A dividend portfolio that provides passive income from consistent dividend payments, either monthly or quarterly, yet provides high returns from high quality dividend paying companies or dividend ETFs, where one day you can retire and live off this passive income and buy just about anything that you want, like a fancy Rolex, pay off your mortgage, get that dream car, and live the life you want. I currently have nearly $16,000 in buying power to deploy into dividend stocks and let my money make more money for me through earning dividends and capital appreciation. My money breakdown is for every $10,000 I have to invest, $1,500 goes to buying high quality dividend stocks, so 15% of my money goes to strictly dividend investing. Now in this video, I'm going to be showing you exactly 2 insane dividend investing strategies that I would do on how to build up a bulletproof dividend stock portfolio with your first $1,000 step by step in one complete guide. So sit down, grab your pens and pencils or your favorite cup of coffee. Now we're going to be diving in slide by slide, kind of like a course or a class, because I used to be a teacher's assistant teaching personal finance and investing at my university not too long ago, so let's get started. To kick us off, we first have the bulletproof dividend investing basics, which type of dividend investing accounts to choose from to store your dividend stocks for tax purposes, and recommended investing apps for liability, followed by the first strategy to build a bulletproof dividend portfolio, and then the second strategy to build a bulletproof dividend portfolio, which is the method that I personally follow for transparency purposes. Let's kick off with what it takes to build a bulletproof dividend portfolio. I'm going to start with the basics. Step 1 is to buy high quality dividend paying companies. Now, how to tell if a company is a high quality dividend paying company is to start looking at the company's financials. Now, we're going to be doing this using Seeking Alpha. Check out the link in the description to get a discount code on Seeking Alpha. We're going to be using Microsoft, ticker symbol MSFT, as an example to research and analyze if this is going to be a high quality dividend paying company. Now, the first factor that I look into is the growth profile of the company. Take the revenue growth, for example, going from 86 billion in 2014 to over 227 billion in just June 2023. Microsoft's revenue is definitely growing at a high yet steady rate. Now, if we look at this revenue growth year over year as a percentage, it's growing at over 11.5%, which is beating the growth of other stocks in its sector of technology. And with the revenues of Microsoft growing, so is the net income growth. The next metric that I look at is earnings. Now, a question to ask is if the company is consistently beating its earnings targets, which will make investors and Wall Street happy. In the case of Microsoft, it's a yes. It has a history of beating earnings or earnings per share. It's consistently growing its earnings per share, growing revenues, and absolutely crushing Wall Street expectations. Now, past results are never an indication of future performance, but as long as the story of the company is the same, the fundamentals of the company remain the same, then I could confidently expect Microsoft to continue to perform well from an earnings and financial standpoint in the future. The last thing I look for a high quality dividend paying company is the dividend that it pays on a yearly or quarterly basis, and not looking at the current dividend yield. For Microsoft, it has a low dividend yield of around 0.7%, but it has consistently grown its dividends for the past 19 years, and it has a 5-year annual growth rate of dividends of 10.2%. We can see that Seeking Alpha provides Microsoft overall an A+ dividend score rating, and as the company's financials are strong, the dividend that Microsoft has paid is growing on a consistent basis, and this all should lead to an increasing share price, which it has of over hundreds of percent over the past years, and it does all of this all while outperforming the S&P 500 on a consistent basis. Now, Microsoft's dividend is a great dividend paying company, even with a strong buy rating from Wall Street analysts on Seeking Alpha, which is only available on Seeking Alpha Premium, so check out the discount code down below. Moving on to step 2 is to reinvest your dividend payments to take advantage of the dividend snowball. Now, the dividend snowball is simply a process of reinvesting your dividends that you earn from dividend paying stocks or ETFs. For example, if I buy 1 share of McDonald's stock and it has paid a total of $6.23 in dividends in 2022, instead of taking that dividend and transferring it back into my bank account, you would essentially have to buy $6.23 of reinvesting your money back into McDonald's stock. And as you might guess, purchasing more shares means earning more dividends, hence the snowball continuing to grow and grow and grow, where you will over time get more dividend payments and then live off those dividends from your huge portfolio like a snowball rolling down a hill, hence its name, eventually having a huge dividend snowball where you can have a ton of dividends, capital appreciation, and live off this nest egg. Step 3 is to invest in companies that grow their dividends and not cut their dividends. Companies that grow their dividends is a sign of financial strength and profitability. It's basically the company saying, hey, we have excess money due to a highly profitable year or quarter of business that we want to give back to shareholders as a thank you. And usually a growing dividend means a growing and rising share price in return, just like Microsoft. And all 3 of these basic principles will allow you to form a foundation for a bulletproof dividend portfolio. Next on our list is we have the best and optimal investing accounts for your dividend portfolio. Now, step 1 is to max out a Roth IRA, where the contribution limit to Roth IRA is $7,000 per year in 2024. On Vanguard's website, it says a Roth IRA is an individual retirement account, hence the IRA, and offers tax-free growth and tax-free withdrawals in retirement. The key word is retirement. Roth IRA rules dictate that as long as you've owned your account for over 5 years, this includes a fund, and you are the age of 59 and a half or older, you can withdraw your money when you want to, and you won't owe any federal taxes, hence it being tax-free. And as some of you may know, dividends do count as income according to the IRS and in tax code. So if you earn a certain level of income ranging from 0% all the way to 20% in taxes. Luckily, the dividend stocks in this video are qualified dividends, which are taxed at a lower rate than dividends that count as ordinary income. So to pay no taxes on dividend income, this is not financial advice, but look into a Roth IRA. And then step 2 is once your Roth IRA is maxed out, follow up the rest of your money with a taxable brokerage account. Now, before we create our dividend portfolios, I want to quickly touch on the best investing apps to hold your dividends with. Now, the first is going to be the big 3, which are Vanguard, Fidelity, and Charles Schwab. These are brokerages that have been around the longest, have some of the best customer service in the world. If you have any questions regarding your investments or even your accounts, they offer a wide range of products like stocks, ETFs, and even mutual funds, and offer some of the highest yields on your money, like in money market accounts, without paying a dumb subscription or a ridiculously high fee like $5, which could be honestly back into your dividend stocks instead of paying the broker. Now, next we have the new kids on the block, which are investing apps that I think are as good as the big 3. 2 of them that I personally love and like are going to be M1 Finance and TD Ameritrade. Just great apps, no fees, overall high quality brokerages. I don't like Robinhood and never encourage anyone to open a Robinhood account from their long history of bad reputation, monthly fees to get access to higher yields on cash, and insights which are literally free on every app on this list. Besides Robinhood, they have horrible and non-existent customer service and overall a bad reputation in the investing community. Now, I do like Webull, E-Trade, Moomoo for international investors, and Interactive Brokers. Now, with all that out of the way, let's build our first dividend portfolio. Now, we have $1,000 to allocate to a starter or even a new dividend portfolio, and I'm going to be creating it on M1 Finance. What I would do is to allocate 9 individual stocks to spread out our risk and not be concentrated into one sector, with one being a dividend ETF to serve as the core of our dividend portfolio or the foundation. I would keep it simple and just spread out $100 all around to 10 different holdings at 10% allocation each. So with our first individual stock at $100 allocated to it, I'm going to be choosing a stock from the technology sector, which is an amazing sector, by the way, for dividend growth coupled with high capital appreciation. 2 stocks I like in this category are going to be a no-brainer of Apple and Microsoft, ticker symbol AAPL and MSFT. Since they have a long history of dividend growth, share price returns, everybody loves and uses their products, and it's at the top of the S&P 500 for a reason. So go with either $100 to either Apple or Microsoft. For me, I'm going to be choosing Microsoft since we talked about this earlier in the video. The second stock that I like in this portfolio mix is going to be a healthcare stock in the healthcare sector. 2 stocks I like in this category are going to be Merck and Johnson & Johnson, ticker symbol MRK and J&J. These are two very famous healthcare stocks. I mean, J&J has products that we all use like Tylenol, Band-Aids, Benadryl, you name it. So I'm going to be going with J&J at a $100 buy-in. For our third stock, I'm going to be choosing a stock from the consumer staples sector, which are companies with business models that are going to be very sticky to consumers and reliable for investors from a consistent cash flow perspective. Companies that I love in this category are going to be Procter & Gamble, Coca-Cola, and PepsiCo, ticker symbol PG, KO, and PEP. We all use and love these products on a daily basis, and if I had to choose one, I would personally choose Procter & Gamble because if anything, I honestly use Procter & Gamble products more frequently than I consume Coca-Cola or Pepsi, so you can't go wrong with either of these three. The fourth stock I like is going to be in the retail category. Now, three stocks that I love are going to be Walmart, ticker symbol WMT, Starbucks, and Home Depot HD. I'm going to be choosing two of these stocks at $100 each. So I personally like Walmart a lot, and Walmart has a history of growing its dividend. And Home Depot is one that I love because Home Depot's type of retail is going to be very sticky for the housing sector as it's a great dividend yielding stock with great growth in dividends. Next up, everybody has to have industrial sector. I love waste management, Union Pacific, and Caterpillar, ticker symbol WM, UNP, and CAT. Industrials is quite an amazing sector for dividends as the yields are usually higher, and a lot of investors, in my opinion, really sleep on this category. Like Union Pacific is one of America's most recognized companies, and even waste management, like seriously, what would we do without the trash man? Big respect and love to those people to do what they do, and legit waste management will never go out of business, hence why both of these stocks provide impressive returns and even a good dividend yield. I'm going to be choosing Union Pacific since we have a lower dividend yield across the board so far, so I would like to have UNP as my choice. Next stock is in the financial sector. I personally work in finance and have a lot of knowledge about this sector personally. Two stocks that I really love are going to be JP Morgan and Bank of America, ticker symbol JPM and BAC. I personally love both of these banks, and honestly, I just love their customer service, their balance sheet and financials, and it's better than Wells Fargo in my opinion. So I'm going to be choosing Bank of America because I do bank with them, and I also have JP Morgan as just my credit card, so I will be choosing Bank of America, ticker symbol BAC. We all love semiconductors, and it's been the rave of the stock market over the past couple of years. And the semiconductor space is amazing given the new advancements in AI and electric vehicles. So the demand for semiconductors is going to be very much needed now and well into the future. I love Texas Instruments, ticker symbol TXN, Broadcom, ticker symbol AVGO, and Nvidia, ticker symbol NVDA in this category. I'm going to be choosing Broadcom since it's a company that I'm most familiar with and it has a way higher dividend yield than Nvidia. The last individual stock in this category of investments is going to be real estate. Two companies I'm most familiar with are going to be Realty Income, ticker symbol O, and Vici Properties, ticker symbol VICI. Traditionally, given how risky it is to hold an individual REIT or real estate investment trust, either one of these individual stocks are going to be awesome. Like I would personally go with Vici Properties since I'm most familiar with them, since the dividends are going to be coming from rental income produced from renters, which are directly paid to you as the shareholder. So you are technically like a landlord in that sense. Lastly, we have the core or the heart of our portfolio, which is going to be a dividend ETF with our last $100. And three ETFs that I love and two I personally even own are going to be Charles Schwab's SCHD, iShares DGRO, and Vanguard's VYM. I personally own both SCHD and DGRO. All three of these ETFs are going to have great starting yields, a long history of track record of returns, and companies that pay dividends of high quality, which will make our portfolio truly bulletproof, since adding in an ETF like one of these really makes your portfolio diversified, high yielding in nature, and will produce healthy returns well into the future. So I'll choose SCHD for our last $100. So there's our first dividend portfolio for dividend investors that I made, and honestly it looks super solid with the great dividend yields, and it has even outperformed the S&P 500. If we invested $100,000, this will even have more money than the S&P 500 since that time period, given the great historical returns. but we can't predict the future. But I'm honestly confident that this portfolio will and can continue to do well into the future. Our second portfolio that I would invest as a starter and that I personally do myself for transparency purposes with $1,000 is my personal portfolio of 50% into SCHD and 50% into DGRO of $500 allocated to both for $1,000 total. So you get the benefit of diversifying your risk with an ETF, you have a super low expense ratio, and hundreds of dividend stocks that are high performing, high yielding, and of high quality. So I made a video on why I combine SCHD and DGRO for a dividend investor, and I personally believe that this is going to be the simple path to wealth with dividends, so go check out that video on my channel for more information. This split of just 2 ETFs makes your life so simple and easy of having 2 stocks to buy instead of 10 on a daily, weekly, or even monthly basis, and you don't have to do all the research into the company, which will take honestly tons and tons of hours to do all the research by yourself on these dividend paying companies, which is why I love and chose this method. The only downside to having only ETFs is maybe you give up some performance, as individual stocks can outperform ETFs in the long run, but really recognize the risk into this because individual stocks are going to be way more risky. Like for example, at one point Starbucks was doing super well till it wasn't as of recently, and DGRO for example has been just going up and up and up and has outperformed Starbucks, which is an individual stock, and the ETF just continues to crush it and even keeps up with the S&P 500. Now I personally invest around $500 to $1,000 per week into these ETFs. Now if you want to see exactly when I buy my ETFs, like the share price, how much I bought them for, and even my thesis on why I bought them on that particular day, you can join my Gold VIP membership group in the link in the description below. Or if you want to show the world what ETFs you love and own, you can join either my Silver or Gold VIP membership group, and I will personally give you a shout out in my next video. Huge shout out to these 3 for subscribing to our membership group so far. Ben with his favorite stocks being VU and Nvidia, Mark as well as Andrew with his favorite stock being Apple and VU. Now that about wraps up this video, guys, on how to build a bulletproof dividend stock portfolio with $1,000 all in a complete guide. Now if you guys like this video, please give it a like because this cute puppy did, and comment down below an ETF portfolio or even an individual stock portfolio of dividends that you made and why you love it. So personally, I love SCHD and DGRO, which is why I love my portfolio. Now if you guys want to check out that SCHD and DGRO video, you can click on the screen right here to go check that out. Now I love you guys so much. Continue to crush in the stock market and take it easy. Peace.